This chart is GameStop GME. That is the poster child from the meme stock era, and they are at it again. They are talking about buying eBay. I'm Rob Haugen from River One Asset Management, and here's a couple minutes on what's going on with GameStop and eBay stock. All right, you might think that the GameStop CEO is a little bit crazy, and he is, but let's give credit where credit is due. This is a company that was probably headed towards bankruptcy, and look where it sits today. They have $9 billion in cash. They've done this by selling stock into the market with these kind of inflated prices. They have $4 billion in debt that they've issued. That is a net cash pile of very close to $5 billion. And here's what really impresses me. They have a declining revenue, right? And most retailers, most brick and mortar retailers, they have margins like 3, 4, maybe 5%. They have 13% margins at GameStop right now and are still building cash behind the scenes. Very good job by Cohen and the crew here to keep this thing afloat. So what can they do with this great cash build? Michael Burry, who has sold his GameStop stock since, has said that they could turn this into an instant Berkshire. What does that mean? Remember Warren Buffett back in the day? He bought a suit liner called Berkshire. That company was headed nowhere. He took the cash from the suit liner and bought other companies at good prices. That is what Cohen has decided he wants to do, and he went hunting for eBay. Let's take a look at how that deal might actually work. So let's talk about why you would want to buy eBay. And the reason is they cash flow. They make money. They might be a mature company, but take a look at what's going on. They're still growing revenue, 13% over the last 12 months, 9% going forward, right? And they're cash flowing net income wise about $2 to $3 billion in cash flow. So when you lever up to buy them, you have a cash flow number that you can fix. Cohen, the CEO, has also said that they're overspending. He said he can take about $2 billion in cost out. So imagine a company where you do that. You take $12 billion in revenue, you take $2 billion in cost off, so now you're making close to $5 billion a year. You paid $56 billion for this company, and if you didn't cash, it takes about 11 years to make back your money, probably about a 9% return. If you guys want to see our commentary on a more regular basis, we do a morning note every trading day. It's free. Feel free to sign up for it, and the link is in the comments. But let's do the math on how they actually would buy this company. This is an $11 billion company in GameStop trying to buy a $56 billion company in eBay. They could use their entire $9 billion cash pile. That's part of it. They say they've got debt of up to $20 billion signed, locked, and loaded. That comes with an interest payment, but it is supposedly out there. But here's the issue. They would have to issue stock. The number is about $27 billion worth of stock. A company that is an $11 billion market cap issuing $27 billion of stock to buy eBay, which does make money, but may or may not after the debt piece of it, is a scary thing, and these shareholders may say no. In fact, Wall Street seems to be thinking this deal is not going to get done, and the shareholders will say no to the massive stock issuance that's required here. So the GameStop CEO is hunting for whales, and he probably should be fishing for walleyes. If he had done this with a much smaller company, everybody would be excited to see if he can turn these companies around, just like Berkshire, buy them at the right price, not put too much debt on the books. This is a massive fish he's trying to land, and he probably bit off more than he could chew here.